Here's the thing. In the last 5 years, a 22-year-old trying to buy a house watched the average home price go up by roughly 50%. In the same window, their entry-level salary went up by maybe 12%. Their groceries went up by 25%. Their rent went up by 30%. Their student loan interest resumed after a pause that lasted long enough for people to forget it was ever paused. And somewhere in between all of that, a 35-year-old on LinkedIn posted about how Gen Z just needs to stop buying coffee and start showing up earlier. Meanwhile, the S&P 500 has returned something like 14% annualized over the last decade. Real estate in most major metros has tripled since 2008. Private equity firms bought single-family homes at scale using institutional capital and zero-interest debt, then rented those homes back to the exact people who could no longer afford to buy them. Venture capital poured into startups that lost money for a decade before going public, and the people who got rich from that were not the workers. They were the shareholders. So here's the question. Was Gen Z unlucky? Or were they handed a system that was never designed for them in the first place, and then told the problem was personal? We are going to explain how the economic conveyor belt works, why it was built by one generation and is now running on completely different terrain, and why most people on it have no idea what speed it is moving or in which direction. This is Creeper Finance. I am 20. Let's get into it. Every generation gets handed a conveyor belt. That is the metaphor I want you to keep in your head for this entire video. A conveyor belt, not a ladder, not a game. A conveyor belt. Because a ladder implies you can choose your speed. A game implies there are rules you can learn. A conveyor belt just moves. It was designed before you got there. It has a speed, a direction, and a destination. And nobody on it necessarily chose any of those things. They just stepped on. The conveyor belt for the baby boomers was built in the post-war expansion. Cheap land, rising wages, a dollar that had just become the global reserve currency, a manufacturing economy that needed workers and paid them enough to buy the things they made. Pensions, unions, 30-year mortgages on houses that cost 2.5 times your annual income instead of 9 or 10. The conveyor belt for millennials was built on the dot-com recovery, the housing bubble, and then partially destroyed by 2008. They had access to cheap credit, but the assets were already more expensive. The starting line moved back, but the belt still worked if you stayed on it and did not get thrown off by the crash. Gen Z got placed on a conveyor belt that was built by the people before them, running on incentives that no longer match the terrain, pointed at destinations that either no longer exist or have been priced out entirely, and nobody updated the instructions. That is the thesis. Now let me explain the 4 places where the belt actually broke. The first one is housing, and I do not mean housing in the vague everyone knows it is expensive way. I mean housing in the very specific, mathematical, nobody told you how bad it actually is way. In 1990, the median home price in the United States was roughly $80,000. The median household income was about $30,000. That is a ratio of about 2.7 to 1. Your house cost you 2.7 years of income. That is the world where the advice just save up a down payment and buy a house was actually logical. Because the math worked. You save for 3 years, you put 20% down, you get a mortgage that costs you less than what you would pay in rent, and the asset appreciates while you live in it. That is not financial strategy. That is just arithmetic that happened to be on your side. In early 2026, the median home price in the United States is hovering somewhere around $430,000. The median household income is around $78,000. That is a ratio of about 5.5 to 1. You now need 5.5 years of your entire household income to equal the price of a median home. Before taxes, before food, before existing. And here is the part that people do not run all the way through. If you earn $78,000 per year and you want to put 20% down on a $430,000 house, you need $86,000 in cash. After taxes, assuming you live somewhere with a moderate state income tax, you take home maybe $55,000 per year. If you save aggressively 30% of your take home, you're saving about $16,500 per year. At that rate, it takes you over 5 years just to save the down payment. That is before accounting for the fact that during those 5 years, the home price is likely rising faster than you are saving. Now, none of this means buying a house is impossible. It means the conditions that made the advice good have changed significantly, but the advice has not changed at all. Your parents are still telling you to save for a down payment. Their parents told them the same thing, and when it worked for them, it was because the math supported it. When you try to run the same play, the math has different inputs. The strategy did not adapt. The world did. That is what I mean when I say the conveyor belt is running on the wrong terrain. The mechanism is the same. The environment is different and the output is therefore completely different. There is another layer here that is worth understanding if you care about systems. The reason housing got this expensive is not just inflation. Inflation is real, but it does not fully explain a 500% increase in home prices over 3 decades when wages went up by maybe 200%. The actual explanation involves 3 compounding forces. 1, institutional capital entering the single-family housing market in a large and sustained way, especially after 2008. 2, decades of restrictive zoning laws in high-demand cities that prevented new supply from being built. 3, interest rates sitting near zero for most of the period between 2008 and 2022, which made it extremely cheap to borrow enormous amounts of money to buy assets, which pushed asset prices up dramatically. Those 3 forces are non-accidental. They are the output of specific policy decisions made by specific groups of people. I am not saying it is a conspiracy, I am saying it is incentives. The people who own homes benefit from home prices going up. The people who write zoning laws often own homes. Institutional investors benefit from buying undervalued assets in a low interest rate environment. Nobody had to coordinate. The system just rewarded those behaviors and punished everyone who got there late. Gen Z got there late. The second broken section of the conveyor belt is education. And again, I want to be precise here because the popular criticism of student loans often misses the actual mechanism. The story most people tell is that college got expensive because greedy universities raised tuition. That is part of it. But the deeper explanation is a textbook example of what happens when you subsidize demand without increasing supply. In 1980, the federal government massively expanded access to student loans. The logic was simple. College produces economic value for the student, therefore lending students money to attend is low risk because they will earn more and pay it back. That logic is sound if the degree reliably produces the income required to service the debt. The problem is that once you guarantee lending to almost any student for almost any program at almost any price, universities have no incentive to compete on cost. They just raise prices, the loans absorb it, the students borrow more. Decade after decade, by 2025, outstanding student debt in the United States is sitting around $1.9 trillion. That is not 1.9 billion, that is 1.9 trillion, with a T. The average borrower carries around $37,000 in federal student debt at graduation, except that average is dragged down by short programs and community college. If you went to a private 4-year university, the number is often closer to 60 or 70,000. And if you went to graduate or professional school, you might be looking at $150,000 to $200,000. Now here is the thing about debt. Debt is not inherently bad. Debt used to buy an asset that appreciates faster than the interest rate is called leverage, and it is one of the most powerful wealth-building tools that exists. I will come back to that, but debt used to buy something that does not reliably generate income is just a cost you borrowed from your future self and have to pay back with interest. A degree in a field that does not have a clear income path in a labor market that increasingly does not recognize credentials the way it once did is not an asset. It is an expensive signal. And the problem is that for decades, the signal was worth something because it was rare. When only 20% of the population had a college degree, having one filtered you into a higher paying segment of the labor market. By the early 2000s, around 30% had degrees. By the mid-2000s, closer to 40%. Now you have a situation where the signal is so common that employers need additional signals, graduate degrees, certifications, experience. The filter just keeps moving downstream, and the cost of chasing it keeps going up. This is not a personal failure. This is a supply and demand problem applied to credentials. When you flood a market with a product, the price that product commands in that market goes down. Gen Z was told to get the degree. Most of them got the degree. The degree got cheaper in signal value and more expensive in dollar cost at exactly the same time. That is not bad luck. That is a predictable outcome of the incentive structure. Now let me be fair to the counter argument here, because there is one. Certain degrees in certain fields still produce exceptional returns. Engineering, computer science, nursing, finance and specific tracks, trades, training, and skilled labor, these still work. Not because the credential is magical, but because the credential is attached to a specific skill shortage in the labor market. Employers pay for skills they cannot find. They do not pay for degrees they can easily find. The mistake is treating education as a category instead of a portfolio choice. And the system never explained that distinction. The conveyor belt just said, go to college. It did not say, go to college for something that has a clear return on investment relative to the cost. And most 18-year-olds are not equipped to make that calculation, partly because nobody taught them how. If you are finding this useful and want to keep understanding how these systems actually work instead of how people say they work, subscribe. I put out new videos regularly. Just hit the button. The third broken section is the attention economy. And this one is the sneaky one, because it does not show up in any balance sheet, it does not look like a financial problem at all. But it is one of the most structurally damaging things that has ever happened to a generation's ability to build wealth. Here's how it works. In 2007, the iPhone launched. Over the following decade, social media platforms engineered themselves around a very simple insight. Human attention is the scarce resource, and the way to capture it is to trigger the brain's dopamine response as frequently as possible. Notifications, infinite scroll, variable reward schedules, these are not accidents. They are deliberate design choices informed by behavioral psychology research. The platforms hired the best minds in the world and asked them one question: how do we keep users on the app as long as possible? The answer was engagement. And engagement is best achieved not by making people happy, but by making them react. Anger, fear, comparison, arousal. These trigger stronger neurological responses than contentment. So the algorithm learned, because it was trained to learn, that provocative content keeps eyes on screens longer than calm content. And then it served more of that content to more people. The result is a generation that grew up with their primary source of social information being a feed curated by an engagement maximizing algorithm. That is not a philosophical problem. It is a practical one, because the brain's reward circuitry, when trained from adolescence to expect short-term variable rewards at high frequency, becomes significantly less comfortable with long-term low feedback activities, which is almost every activity that actually builds wealth. Investing is boring. Nothing happens for months. Sometimes years. You put money in, you check it, it went up 2%, you check it again, it went down. 1%, you wait. This is the game, and it has an extraordinary expected value over 10 to 20 years. But the brain trained on 60-second video content and real-time engagement metrics finds this almost physically uncomfortable. Not because Gen Z is weak, but because the architecture of their information environment was specifically engineered to make low stimulation activities feel intolerable. This is a second-order effect that almost nobody talks about. We talk about social media and mental health. We talk about screen time, but we do not talk about the fact that the attention economy specifically selected against the psychological habits that compound wealth. Patience, delayed gratification, tolerance for ambiguity and boredom, willingness to follow a slow feedback system without quitting. The conveyor belt now has a fork in it. One path is the attention economy path. Constant stimulation, high engagement, zero compounding. The other path is the boring one, the one that looks like nothing is happening, the one where you invest early and consistently, learn skills that take years to develop, build assets that do not feel exciting in year 1 or year 2 or year 3. The attention economy path feels better in the short term, the boring path works better in the long term, and the entire design of modern media is pointing you toward the wrong fork. Now here is the part people miss. Some people figured this out, not by being smarter, by noticing the pattern. And that brings us to the fourth section, which is the one where this whole thing starts to resolve into something actionable. Let me give you a short scenario, not a personal story, just a model. Imagine two people, both 22, both with the same starting salary, $60,000 per year, working in the same city. Call them Alex and Jordan. Alex grew up hearing the standard script: get the degree, get the job, buy the house eventually, contribute to the 401k up to the employer match. This is the conveyor belt. Alex follows it. Jordan, for whatever reason, encountered a different set of information, maybe a YouTube channel, maybe a book, maybe a conversation. Jordan understood that the conveyor belt exists, that it was designed for a different era, and that the default settings are not optimized for current conditions. So Jordan made a few different decisions. Jordan did not try to buy a house immediately. Instead, Jordan rented a cheaper place than they could technically afford, kept housing costs at around 25% of take-home pay, and redirected the difference into a taxable brokerage account. Jordan also maximized the 401k, not just to the match, all the way to the limit, which in 2026 is $23,500 per year. At $60,000 gross, after taxes, let's say Jordan takes home around $47,000. If Jordan puts $23,500 into the 401k, that reduces taxable income. So the actual cost in take-home terms is closer to $17,000, not $23,000. Meaning Jordan is putting in $23,500 in pre-tax dollars by sacrificing about $17,000 in after-tax spending. That gap, almost $7,000, is a gift from the tax code. Most people do not use it. Jordan lives on about $30,000 per year. That is tight in a lot of cities. Not impossible. And Jordan does this for 5 years. Alex, in those same 5 years, contributed to the 401k only up to the match, drove a slightly nicer car, ate out more, and lived in a slightly nicer apartment. Alex did not save less out of irresponsibility. Alex followed the default. Alex spent what felt reasonable for someone at their income level, which is what most people do. At year 5, Jordan has roughly $140,000 in the 401k, assuming a 7% average annual return, plus maybe $20,000 to $30,000 in the brokerage account. That is approaching $170,000 in invested assets at age 27. Alex has maybe $35,000 in the 401k and a couple thousand in savings. Now here is why that gap is more important than it looks. In investing, the variable that matters most is time. Not the amount you put in, though, that matters too. Time. Because compounding is exponential, not linear. Jordan's $170,000, left in the market with no additional contributions, grows to approximately $650,000 by age 52 at 7% annual return. And Jordan will continue contributing for another 25 years on top of that. Alex has to contribute far more money for far longer at a higher emotional cost, just to catch up, and will probably never fully close the gap. The difference in outcome is enormous. The difference in behavior was modest. Jordan did not do anything heroic. Jordan just understood the system slightly better than Alex did and adjusted early. That is the entire game in its simplest form. Here is a short pause for something that I think is genuinely absurd and deserves a second of acknowledgement. One of the most effective retirement savings vehicles available to American workers is called the 401k. It has existed since 1980. It is employer-sponsored, it reduces your taxable income, and the money inside it grows tax-deferred for decades. The contribution limits have been adjusted upward over the years to account for inflation. It is by most objective measures one of the best legal wealth building tools that ordinary wage earners have access to. The government does not teach this in schools. Employers mention it once during onboarding in a 45-minute presentation that also covers the badge access policy and the parking garage rules, and then they never bring it up again. We just collectively decided that the most important financial decision most people make in their 20s is best communicated alongside information about where to find the bathroom. Okay, moving on. The fourth broken section of the conveyor belt is what I want to call the leverage gap. And this is the one that makes the difference between people who escape the system and people who just keep running on it. Most people think about income in a linear way. You work an hour, you earn a wage for that hour, you work more hours, you earn more money. This is actually the mental model that the entire school system and the entire hiring infrastructure is built on. You are paid for your time. Your time is the input. Your wage is the output. The problem is that time is a fixed resource. You have 24 hours in a day. Even if you work 16 of them, you have hit a hard ceiling. There is no leverage in that model. The output scales exactly as fast as the input and no faster, which means your income is permanently capped by how many hours you physically have. Wealth, on the other hand, does not work like that. Wealth is built through leverage, and leverage has a very specific meaning that has nothing to do with debt in the pejorative sense people use. Leverage means that your output scales faster than your input. You put in 1 unit of effort or capital and the system multiplies it. There are a few forms of leverage. Capital is one. When you invest money, your money works while you sleep. You do not have to be present. The asset earns a return whether you are working or not. This is why people who own assets get richer in periods when people who own only labor often do not. The asset keeps producing. Labor requires you to show up. Code is another form of leverage. A piece of software runs millions of times without the programmer being present. The programmer wrote it once. The leverage is infinite, or close enough not to matter. This is why a small number of engineers have generated enormous wealth in the last 30 years. Not because they worked harder than factory workers, but because their output scaled without their presence. Media is a third form of leverage. A video, a book, a piece of content, an article. Created once, consumed repeatedly. You make it once, it earns attention, subscribers, and potentially income, indefinitely. This is why certain content creators have built meaningful businesses without institutional capital. They leverage the distribution infrastructure of platforms to reach enormous audiences with zero marginal cost per additional viewer. People are a fourth. A manager who directs the work of 10 people has leverage over labor. A business owner who has hired a team has leverage. Not in an exploitative sense, though that happens too, but in the mathematical sense that their decisions have multiplied impacts compared to a solo operator. The mistake that most people make, and it is an understandable mistake because they were never shown the alternative, is spending their entire 20s and 30s optimizing the wrong variable. They get better at trading their time. They negotiate a higher hourly rate, they work more hours, they get promoted. All of these increase the numerator in the output per hour equation. But they never change the denominator, which is the hours themselves, and the hours stay fixed. The conveyor belt incentivizes this. School is about showing up on time and completing assignments. Jobs are about being present and productive. Promotions reward consistency and accumulated institutional knowledge. These are all time-based metrics. The entire formal infrastructure of modern economic life is organized around time as the primary unit of value. And then people wonder why they feel like they are running fast but not getting ahead. Gen Z specifically inherited a version of this problem where the traditional leverage point that previous generations used, real estate, became much harder to access right at the same moment that new forms of leverage became available. Code, media, digital assets, information products, remote work that allows geographic arbitrage. These are not replacements for real estate, but they are legitimate forms of leverage that are available without needing a $100,000 down payment. The people I have watched build serious wealth in their early 20s, and I am talking about people who are genuinely financially independent or close to it. Not people who made a lot of gross revenue, almost none of them did it through a salary. They did it through some combination of capital compounding, building a business with some kind of scalable output, or acquiring an asset that produced passive income. Not because they were geniuses, because they understood early that the time for money trade has a ceiling and they needed to get above it as fast as possible. There is an important clarification here. None of this means you should immediately quit your job and start a business. That is often the wrong move, and it is definitely not the move I am endorsing. What I am saying is that your job is not a wealth strategy. Your job is an income source. It is a reliable, predictable cash flow that you should be using as fuel for actual wealth building activities. Investing, building side income that does not require your time, acquiring skills that translate into leverage later. The job is the feedstock. The compounding engine is separate. Most people never separate these two things, and they spend their entire careers thinking of their salary as their wealth instead of as the raw material for wealth. Now, let me connect this back to Gen Z specifically, because this is where it gets genuinely interesting rather than just depressing. Gen Z was handed a broken conveyor belt. That is true. Housing is harder, credentials are more expensive and less valuable. The attention economy is designed to erode the psychological traits you need to compound wealth. The leverage gap is real, and most people do not understand it. But here is the contrarian point. And I mean actually contrarian, not fake contrarian in the way that financial media likes to be. There has never been a better time in history to build wealth without asking anyone's permission. And I will explain what I mean by that specifically. In 1980, if you had an idea for a business, you needed capital to start it, you needed a physical location, you needed to pay employees before you had revenue, you needed a relationship with a bank that would lend to you, you needed suppliers who would work with you. The barrier to entry on almost every type of business was high enough that most people simply could not get over it without institutional backing or significant personal capital. In 2026, you can start a service business for $0. You can reach a global audience with no distribution budget. You can hire contractors without taking on payroll. You can sell information products, build software, consult, broker, or create with nothing but a computer and an internet connection. The marginal cost of starting many types of businesses has dropped to something close to zero. The distribution infrastructure that would have cost millions to build in 1995 is available free with a platform account. This does not mean it is easy, it means the barrier is different. The old barrier was capital, the new barrier is attention, skill, and persistence. And while those are all harder to borrow than money, they are also not rationed by gatekeepers. Nobody can decide you do not have access to attention or skill. You either build them or you do not. The Gen Z cohort that figures this out, and some of them already have, is going to look very different financially at age 35 than the cohort that followed the default conveyor belt. Not because they worked harder, because they identified where the leverage actually is in the current environment and went there instead of where they were told to go. Let me give you the 3 things that actually change the output if you are starting from the current conditions. The first is asset accumulation speed, not lifestyle inflation. Most people, when their income goes up, increase their spending proportionally. This feels natural. You earn more, you spend more, you feel like you are progressing. But your net worth is not your income. Your net worth is the difference between what you own and what you owe. A person earning $150,000 per year who spends $140,000 and invests $10,000 is building wealth far more slowly than a person earning $80,000 who spends $45,000 and invests $35,000. The second person is building wealth at 4 times the rate despite earning less. That math is available to anyone. Most people never run it. Speed of asset accumulation in the early years is disproportionately valuable because of compounding. A dollar invested at age 22 is worth roughly $8 at age 52 at 7%. A dollar invested at age 32 is worth roughly $4 at age 52 at the same rate. You are not twice as far behind by waiting 10 years. You are approximately half as wealthy at the end. And you cannot get those years back. The compounding clock is running from the day you have capital to invest. Every year you delay is not a neutral decision. It is a permanent reduction in your terminal wealth. The second is selectivity about debt, not debt avoidance, selectivity. There is a version of debt that builds wealth and a version that destroys it. The version that builds wealth is debt taken to acquire an asset that produces income or appreciates at a rate higher than the cost of the debt. A mortgage on a rental property that generates positive cash flow. A business loan used to buy equipment that produces revenue exceeding the loan payments. These are leverage. The version that destroys wealth is debt taken to fund consumption. Car loans for depreciating vehicles, credit card balances for things you already ate or wore, buy now, pay later for electronics. These are not leverage. They are deferred costs with interest attached. The conveyor belt normalizes both types of debt equally, which means most people never make the distinction. The third is what I would call information asymmetry hunting. This sounds complicated, but it is simple. Every market has participants who know more than others. The participants with better information systematically extract value from the participants with worse information. This is not fraud. It is just how markets work. The question is which side you want to be on. In the stock market, the information asymmetry between retail investors and institutional investors is enormous, and you should not try to compete in that specific arena. But in smaller markets, local real estate, niche skills, early stage opportunities, specific industries, the gap is much smaller. People who do the work to understand a specific market deeply and specifically operate with a significant advantage over people who do not. And right now, information is more accessible than it has ever been. The gap between knowing something and not knowing it has never been smaller in terms of the effort required to close it. That is an advantage that was not available to previous generations in the same way. But it only matters if you actually use it, which most people do not. Here is the full picture, and then I will land the plane. Gen Z got placed on a conveyor belt that was built by people whose economic reality was fundamentally different. Housing was affordable relative to income. Credentials were scarce enough to command a meaningful wage premium. The information environment was not deliberately engineered to destroy patience. Leverage was available through real estate at accessible price points. The belt made sense for the people who designed it. It does not make as much sense for the people running on it now. But the response to that is not to feel bad about it. The response is to understand what the belt actually is and make deliberate choices about which parts of it to follow and which parts to route around. The belt that still works. Invest early, invest consistently, use tax-advantaged accounts to their limits, live below your income, avoid consumer debt. These have not broken. They just require more intentionality because the margin for error is smaller than it was for your parents. The belt that needs to be routed around: assume a degree automatically produces income. Assume owning a home is the primary wealth building vehicle. Assume a salary is a wealth strategy. Assume working harder inside a time for money exchange will eventually produce financial freedom. These parts of the belt are leading somewhere significantly less interesting than they used to. The thing nobody really prepared Gen Z for is that the map changed and the instructions did not. And that specific gap between the map people are using and the territory they are actually walking through is where most of the pain is happening. Not laziness, not entitlement, not too much avocado toast. A mismatch between inherited advice and actual conditions. The people who figure that out and adjust accordingly and do it early enough for compounding to do its work, those people are going to be fine. More than fine. Because the same forces that made the system harder to navigate on the default setting also created openings that did not exist before. Lower barriers to starting businesses, global access to capital markets from a phone, distribution channels that require no physical infrastructure, new forms of leverage that were not available at any price 30 years ago. The conveyor belt is broken in some places, but it is also running through terrain that has doors in it that were not there before. Most people on the belt are looking down at their feet. The ones looking sideways are finding the doors. That is the move. If this video made you think about something differently, subscribe. I am putting out this kind of analysis regularly, and the next video is going to cover something that will make this one feel like an introduction.